This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, as we said at the end of the previous chapter, and as you see written here at the beginning of this chapter, what we've been able to do through Chapter 4 and Chapter 5 is to initially establish an adjusted trading profit for the business for an accounting period, and then in Chapter 5 compute and deduct the capital allowances available for the self-same accounting period. We deduct those capital allowances, we said, from the adjusted profit, we get the tax-adjusted trading profit. And that will be for that business's, that individual's chosen accounting period end. The thing is that an individual may choose any accounting period that they wish to. They don't have to pick a 5th of April. So how is it, we said at the end again of last time, how do we take what could be any accounting year end that the proprietor of the business chooses to use for their business and relate that to the tax year in which it will be assessed? Go all the way back in your heads now to Chapter 2, and we saw the preparation of the income tax computation. And we saw that for most sources of income, it was an actual basis of assessment. In earned income, employment income was the other big one as compared to now trading profit, as you see here. Employment income basis of assessment, actual amounts received. What we mean by that received basis we see in Chapter 9 on employment income. In terms of our unearned, our investment sources of income, whether we're talking about property income, whether we're talking about in other forms of investment income, interest income, or indeed dividend income, we used the same basis of assessment, a received basis. We did see that in property income, we could revert back to the old system of accruals for the individual concerned, but unless we were told that it was going to be a received basis. So all we had to worry about so far is when we prepare the income tax computation for the 2019-20 tax year, that runs from 6th of April 19 to 5th of April 20. So what do we need to do? What we do need to do is to ensure that we picked up every amount received for employment income, for property income, for dividend income, for interest income in that 12-month period, 6th of April 19 to 5th of April 20. But we've got a problem here when it comes to, as I say, dealing with trading profits. So, of course, not a problem that can't be overcome, and therefore we use something that you're going to come to know and love as the current year basis. I may have lied there when I said love, of course. The current year basis. This is the normal basis of assessment that is used. And what we're told here is that traders are assessed on their trading profit using this current year basis, or as we will know it from now on, as we said, CYB, current year basis. What is that? It's very simple, actually. It is the tax adjusted trading profit. We know that. That's what we've done in Chapter 4 and then Chapter 5 of the accounting year. And that's going to be an issue only when we have an accounting year, not any other length of period, but when we have an accounting year, are we able to use this current year basis? If we don't have an accounting year end within our tax year, that's what this bit goes on to say, ending in the tax year of assessment. If we don't have that, which is a situation often in opening years and in closing years, then there are special rules, special bases of assessment for dealing with those two scenarios. And in all honesty, that's what most of this chapter is actually about, dealing with those situations of opening and closing years of either a new unincorporated trade commencing that trade or an old trade ceasing that trade. But if it's just a normal continuing business with an accounting year end, year after year after year, then the normal basis CYB may be used. What does it mean for the tax year 2019-20? Basically our tax year for which you will have to prepare an income tax computation in some small part or in total. Then for that tax year, what do we want? We want the tax adjusted trading profit of the accounting year that ends in that tax year. So if, as we suggest here, a trader prepares accounts to the 30th of June in each year, and we are looking for which year ended the 30th of June will be assessed in our tax year of assessment, 1920, then the assessment will be based on the tax adjusted trading profit for the accounting year ending the 30th of June, which 30th of June ends in the 1920 tax year, i.e. which 30th of June falls between the 6th of April 19 and the 5th of April 20. Well, that should be very obvious. 30th of June falls in the 1920 tax year. That is the year ended 30th of June 19. Yeah, the 30th of June 19 is the 30th of June falling in the 1920 tax year. And then it will go on. The 2021 assessment, what 30th of June falls in the 2021 tax year, and that is clearly the year ended 30th of June 20. Again, if I'm searching to get the CYB assessment for the 1920 tax year, its income tax computation, and the business prepares its accounts to the 31st of December. Well, what 31st of December falls within the 1920 tax year? Well, year ended 31st of December 19. That's the date falling in the 1920 tax year. So this part is a straightforward exercise. Just to make sure you have understood that, by the way, a quick little example for us to, again, hopefully very quickly work through here. Andrew prepares accounts to the 31st of March. Which tax year will we assess the trading profits of the accounting year end 31st of March 20? Now that's not quite the 5th of April, but it's as close to the end of the tax year using a normal month end that we can get. So 31st of March 20. Which tax year does that fall in? Well, it falls just before the end of the 1920 tax year. Runs from the 6th of April 19 to the 5th of April 20. So if it is year ended 31st of March 20, that will be assessed in the 1920 tax year. That's assessed in 1920 tax year. Eric, on the other hand, prepares accounts to 31st of August and therefore has an accounting year ended 31st of August 19. So again, in which tax year does the 31st of August 19 end? It's again, obviously, the 1920 tax year. Where we do have to be just a little bit careful is where we do have those accounting year ends either side of the 5th of April, either just before the end of the tax year, as was that one, the 31st of March 20, was just before the end of the 1920 tax year. So it falls in the 1920 tax year. So that is the period to be assessed, year ended March 20. Either that or this one, where this time Kathy, she prepares accounts to the 30th of April. And if we're looking at the year ended 30th of April 2020, so that's only, again, look at that one 1 month later than having chosen the 31st of March. But if we choose year ended 30th of April 2020, then that one now falls in the 2021 tax year and therefore will be assessed in that 2020-21 tax year. So it should be a simple process for a tax year, which accounting year ends in that tax year. That tax adjusted trading profit is what will then feature on the income tax computation, as we saw in Chapter 2, that we prepare for that taxpayer for that tax year. Now, it's possible as part of a bigger income tax computation that that's all you've got to do. Here is a choice of 2 or 3 year ends with the tax adjusted trading profit, and you've got to pick the one that is relevant for our tax year of assessment, the 1920 tax year. Or, more usually, either for 2 marks as an objective testing question or potentially 2 or more marks as part of a constructive response question in section C, we may have to deal with either of the 2 circumstances that we've already suggested to you. What happens when a business first starts to trade? Because again, businesses don't always start on the 6th of April and then choose the following 5th of April as their accounting date, so that immediately from the very first tax year you could use CYB. We will discover that it may be the 2nd, the 3rd, or in certain circumstances, even the 4th tax year before we end up being able to use CYB. Well, guess what? HMRC do not wait around until the 2nd or the 3rd or even the 4th tax year when you actually have a current year basis for you then to be assessed to tax. From the very first tax year in which you trade, we need to have a basis of assessment because HMRC are going to assess you on some figure of profit. So what we now need to look at, and what you need to learn, you will do so as ever with practice, is what are these bases of assessment in the opening years. Now, I'll forewarn you here. The rules for opening years are rather more detailed because there's lots of different possible scenarios you could see based on when did you start to trade, what accounting date do you then choose to use for that business. There's a lot of different alternatives. We need to learn and practice the rules. Don't worry having spent quite a lot of time on that when we then come to look at the closing year rules when a business ceases to trade. There is just one set rule. So that's a whole lot quicker and easier to deal with. So again, forewarned is forearmed, as they say. Opening years are going to take us a little bit longer to be able to deal with. It will take you, therefore, a little bit longer to deal with them as well, and will require a lot of practice on your part. Okay, so one of these special rules that apply in opening years are opening tax years of a new trade until we get CYB assessment falling available. As soon as it is available, we will use that, and we'll use it continuously then through to the end of the life of that business, and we then run into whatever are the closing year rules. As we've just said, a new business is very unlikely to start trading on the 6th of April and prepare accounts through to the following 5th of April, thus allowing CYB to operate from the first tax year onwards. As we'll discover, as I said, it may not be until the 3rd or even 4th tax year before we have CYB, before we have an actual accounting year. Again, remember, for CYB to apply, it is not just having an accounting date that ends in that tax year, it's having an accounting year that ends in the tax year, and thus allows CYB to apply. As we've said, HMRC don't wait around until you have CYB. They're going to assess a taxpayer for the very first tax year in which they trade, and hence we need to know a basis of assessment for the first tax year and every other year from there on. As we'll see in these rules, actually the first tax year is very easy to deal with because there is just one single scenario, one basis of assessment, and we use an actual basis of assessment. What does that mean? We will assess the profit actually made from the date the trade commenced through to the following 5th of April. What profit was actually made for the period start of trade to 5th of April. Now, again, unless you have prepared accounts to the 5th of April, what you're going to have to do is some sort of apportionment here. The opening period may start in the first tax year and end in the second tax year. Therefore, we have to take a portion. We'll do an apportionment of that opening period. So many months out of however many months of that opening period, what amount of that period falls into the first tax year. An apportionment. It could be you start trading in, obviously, your first tax year, and you prepare accounts for a relatively short period, which actually ends also in that tax year. So you still need actual start date to following 5th of April. So it's all of the opening period of profit plus a bit of the second period of profit. So we're going to have to do apportionments. Some messy little calculations are going to be required potentially here. But the basis of assessment is simple. It is actual. What profit was made from start date to the following 5th of April. But again, remember, we must be looking at that as a part of an accounting period, or all of the opening period and a part of the second period. We'll see that with practice in a few minutes' time. As we said, the only issue here is some time apportionment of a profit period will be required if we prepare to accounts to a date other than 5th of April. Again, as close as you'll ever get to, unless they tell you 5th of April, is the 31st of March. All of our time apportionments that we do here will be to the nearest month, so 31st of March effectively equates as the same as the 5th of April. Be sure, however, to correctly determine in which tax year you started to trade. What is the first tax year? For that, you look at the start date. Now, again, it may seem very, very obvious that the start date will fix the first tax year, and it should be obvious what that tax year then is. But it's amazing how in an exam circumstance, it is very easy to make a silly mistake there, such as I'll point out to you with the examples that we will do. So the first tax year is simply enough, actual basis, start date to the following 5th of April. But it's then the second tax year when problems start to arise. And as I've said to you, it will take time and it will take practice on your part to get to grips with this. Because in the second tax year, there are various alternative bases of assessments that may apply, which again, as I said to you a moment ago, will be based on what accounting date did you choose, and the detailed rules for this in the third year of assessment follow then. I believe they follow on now. What we have said is that you get to choose when you start to trade, and you also get to choose what your accounting date is. So depending on when you started and what accounting date you choose, though we know that the first year will always be actual, year one will be actual here, the actual profits from the start date to the following 5th of April. Year two, you are left with, depending on what choice you made about your accounting date, then there's different options. And we have to go through this in a set order to determine which basis of assessment will be used. And we do it to begin with by asking a question. There's going to be a series of questions that we pose. The first one, simple. Is there an accounting period which ends in that second tax year? Now, I haven't said accounting year, I've said an accounting period. If you had an accounting year that ends in that second tax year, problem over. You are now able to use current year basis, and you will continue to use current year basis thereafter. You have moved quickly and easily from an actual basis in the first year to CYB in the second year and beyond. Now, of course, the chances of that happening in the question pretty remote because it's way too easy. So we look to see, do we have any accounting period at all that ends in the second tax year? Now, as we've said, if it were an accounting year ended in that second tax year, it would be current year basis you use. So if you have an accounting period that ends in the second tax year, but it isn't a year, it must be one of two things. It's either going to be a period of less than 12 months, a short period ending in that second tax year, or it will be a period of more than 12 months that ends in that second tax year, a long period ending in that second tax year. And depending what outcome we find here, that will dictate the basis of assessment. So let's assume that the answer to our question, do we have any accounting period at all ending in that second tax year, that the answer is yes. We then ask the question, how long is that accounting period? As we've said, if it was exactly 12 months, a year, then you would use current year basis. If it's not a year, then it is either short, less than 12 months, or long, more than 12 months. So if which of those is the case, what basis do we then use? Right. If it's a short period that ends in the second tax year, like we start to trade on the 1st of January, and then we prepare accounts to the following 30th of June. That's 6 months to the next 30th of June. There you would have starting one tax year, the 1st of January, prepare accounts to a date in the next tax year, 30th of June. You passed over that 5th of April, 6th of April date, and it's a short period. So there would be, therefore, an accounting period of 6 months ending in that second tax year. What do? We assess the profits for the first 12 months of trading. So if that's a short period, we'll take all of it plus however many months we then need from the next period there, which will it be a year end, only the opening period will be other than a year, to bring up that opening period from, like in my example, 1st of Jan to 30th of June, that's a 6-month period. We need to assess the first 12 months of profit, so we take a further 6 months from the second accounting period, which would of itself be a year end. We'll take half of that, 6/12 of it. So, first year, always actual basis. Start date to following 5th of April. Second year, first question. Do we have an accounting period ending in that second tax year? Answer, yes. And most times the answer is yes. But the next question then is, if that period isn't exactly a year, is it short or is it long? Is it less than 12? Is it more than 12? If the period here is a short period, less than 12 months, like my 1st of January to 30th of June, a 6-month period, then what is the basis of assessment to use? As we see here, the profits of the first 12 months of trading. Start date to a date 12 months later. If, on the other hand, you have a long opening period, i.e. more than 12 months, then you're still going to assess 12 months of profit from the second tax year onwards till you get to the final tax year anyway. You're always going to assess 12 months worth of profit. It's a tax year, so you will assess 12 months of profit. The only question is which 12 months of profit will be assessed. Once you're up and running on CYB, you know what it is. It's the profits of the 12 months the accounting year ended in that particular tax year. So here in the second tax year, if we have a short period ended, take the profits of the first 12 months. If it is a long opening period, then which 12 months we assess the profits for the 12 months to that accounting period end date ending in that year. So we take the last 12 months of that long opening period, the 12 months to that accounting period end date. If it's a 15-month, a 16, an 18-month period, whatever it might be, more than 12, we take the 12 months to that accounting period end date, i.e. the last 12 months of that long opening period. Okay, we'll come to year 3 in a moment. Usually by year 3 we have current year basis. There's just one situation in which we don't, and we'll deal with that separately in a moment's time. We'll come on to this bit by means of an example, and we'll deal with a little example now. So if you could just get paper and pen ready there, and we'll go through a little example. So we'll pause for a moment while we get ourselves set up, and I'll detail an example for you. Okay, here's our first example for us to deal with, therefore, and the process that we now undertake. Having determined from the information in the question that you're dealing with a startup, a new unincorporated trade, we must firstly establish the assessment in the first tax year. So we need to know what is that first tax year. Find the start date. Taxpayer commences trading on, there we go, the 1st of January 2020. So in which tax year does that date fall? Now again, don't make a knee-jerk reaction here in relation, all right, this is easy. We started in 2020. These tax years have got double-barrel names, so it's 2021 the first tax year. That classic student error. No. Some of you will be thinking, well, of course not. And I hope you are thinking that. Of course it's not 2021. The 1st of January 2020 falls within the 1920 tax year. It starts there between the 6th of April 19 and the 5th of April 2020. It's the 1920 tax year. So that 1920 is our first tax year. But it used to be surprised because I'm telling you this. But over the years, how many students I've seen make this mistake? They don't think, they react. Oh, we start in 2020, ignoring what month and date of the month it is. We start in 2020, so it must be 2021. Silly mistake, which is going to cost you. If you're doing an objective testing question for 2 marks where it's either right or wrong, you make that mistake now and you are guaranteed to get the wrong answer at the end of what might be 2, 3, 4 minutes worth of your time invested to establish an assessment for a particular, the relevant tax year required. So again, I know I'm labouring the point, but don't make that mistake. It could cost you dearly. So take time, check it out. What is your first tax year? We know that for us, it's 1920. And then what does the taxpayer do? Prepares accounts to the 30th of September in each year, starting with the accounting period through to the 30th of September 20. So started on the 1st of January 2020, prepares accounts for clearly then what is a 9-month period, the 30th of September 20. Again, do understand that that opening period doesn't have to be a 12-month period. And given that we know that apportionments are going to be necessary in dealing with the assessment for the first tax year and then the second tax year for sure, if not indeed also the third tax year, do make sure you correctly determine the number of months. They're not always going to be as straightforward as this, where you start on the 1st of January and you know that September is the 9th month of the year and so it's a 9-month period. It could be any date to any date. Get that opening period sorted. Is it, if you were lucky, a year end? More likely is either as here, this is a short period or potentially could be a long period. But not just is it short, is it long? How long is that period? Because you're going to need that in the calculations you go on to do. Again, be aware, be careful, don't make silly mistakes. So that therefore is an opening period of 9 months in which we've made a tax adjusted trading profit from the work we've done in chapter 4 and 5 for that 9-month period of £36,000. We've chosen our accounting date 30th of September, so then accounting year ended 30th of September 21 will be our first full year, where we've made 60,000. Now, until you have a year end, as we do here, you couldn't use CYB. So the first CYB assessment is going to be based on that year end date, the 30th of September 21. If you ask yourself that question at this point in time, you will now know which is the first tax year in which CYB will be available to you. And that may avert you making another silly mistake as you move through from the first tax year onwards. So, 30th of September 21. Which tax year does that date fall within? Clearly September 21 equals the 21-22 tax year. So you now know that until you get to the 21-22 tax year, you will not be able to use CYB. First time you can use it, there, 21-22, you will use CYB for the first time. Now our first tax year is 1920. We already know, based on what we have seen so far, is that the first tax year, there is no choice, it's an actual basis. Start date, which we know to be the 1st of January, through to the following 5th of April, an actual basis of assessment. And as we suspected, our problem is going to be for the second tax year. So let's see how we now take that information that we've picked up on, we've interpreted it so far in relation to what was the start date, what was the first tax year, what is the first full year end that we have, therefore using CYB, what is the first tax year for which CYB will be available. Is there a gap there? Yes, between 1920 and the 21-22 tax year, there's the 2021 tax year. And that second tax year, as I've said to you, it's always going to be, that's the tricky one. We simply have to sort out what basis period will apply to it. Well, let's see how we put together our answer to this. Now, I know if you're answering an objective testing question, presentation is irrelevant. You either pick the right answer or you don't. But again, until you get much better at this, I would suggest, and certainly if you've got to do this in a Section C question, that you set it up in the way that I'm going to show you here. Right. First tax year we have identified. It is the 1920 tax year. What is the basis of assessment? We know that that will be actual basis of assessment. So if it's a Section C question, I'm telling the examiner, in my workings here, I know the first tax year, I know the basis of assessment. I then define the basis period, i.e. what does actual mean? It means from your start date, 1st of January 20, through to the following 5th of April. Well, that pretty obviously is the 5th of April 20. So I've got my tax year, I've got my basis of assessment, and I've got my basis period defined. Now all I've got to do is to put that into practice. Right. Remember, we take the 5th of April as being, we do apportionments to the nearest month, so that is effectively to the first 3 months of the year, January, February, March. We don't do daily, we do monthly apportionments. So that period is 3 months. Out of, how long was the opening period? It was a period of, back to it, 9 months there. It was a 9-month period to 30th September. So, remember, check what's your numerator, start date to following 5th of April, 3 months. What's your denominator? How long was that opening period? It was 9 months. What was the profit for that period? That was £36,000. 3/9 of £36,000 will equal, what will that assessment be? 3/9 of 36, well that's a third of 36, so that's going to be £12,000. What does that mean? It means that if you were then required to prepare the income tax computation for the 1920 tax year, you now know that for the 1920 tax year of assessment, £12,000 is the tax-adjusted trading profit to include upon the income tax computation for that 1920 tax year. So you've now been able to get your 36,000 through adjustment of profits and capital allowances work, and now in Chapter 6, established what basis of assessment will apply in this first tax year of trading, 1920. It is actual. What basis period is that? Start date to following 5th of April. How many months is that? Out of how many months worth of opening period? And there is your assessment. If that's all they wanted for you to establish or prepare the income tax computation for 1920, then you've got what you need to know. It's a £12,000 assessment. But of course, what you could have is an exercise that is asking you to work the assessments for all of the tax years relevant to the profit periods provided to you. So we've got to move on now and look at what assessments will profits of £36,000 and £60,000 for those given periods, what tax years will we use them in? Right. First tax year, therefore, I hope you see is straightforward, but look at the presentation I've given to you. What is the tax year? What is the basis of assessment? What is the basis period? And then do the calculation. Now, if you're doing an objective testing section A question here, and they just want what's the assessment in this tax year, then you, of course, don't need to write all of this. You just need to apply it. So you'd hopefully be able to say to yourself, right, start date 1st of Jan 20, that's 1920 tax year. If that's the year they want me to work the assessment out for, it's the first year. That therefore is an actual basis. What do I mean by actual here? Start date to following 5th of April. There it is. And then do your calculation and get your figure. And hopefully that is a figure as one of the 4 alternatives for your objective testing question. And you pick your solution. But if we have to do the whole exercise, having dealt with the first year, 1920, we now know that the second tax year will be 2021. And this is where life gets more interesting, shall we say. What basis of assessment do we use? If needs be, go back to the notes you have in front of you. And those notes said that in the second tax year, you pose the question, do you have any accounting period at all that ends in this second tax year? For us here, 2021. What is our accounting date? It's the 30th of September. What is the first set of accounts that we prepared to the 30th of September 2020? Right. Does the 30th of September 20 end in the 2021 tax year? Yes, it does. So, answer to first question, do we have an accounting period ended? Yes, we do. Second question, how long is that period? Is that period short or long? Well, it's a 9-month period. It's a short period. It is less than 12 months. If we have a short period ended in the second tax year, what is our basis of assessment? Basis of assessment is the profits of the first 12 months. What would that be as a basis period? We started on the 1st of January 20, and therefore a date 12 months later would be the 31st of December 2020. There is your first 12 months basis period. Okay. What profits will therefore be included therein? The profits that will be included will be, firstly, the profits of your opening period, which was the 9 months through to the 30th September 20, and that was £36,000. I think, if I remember correctly. Let's go back. Oh yes, 36,000 we've used there. 36,000. The next period, year ended September 21, 60,000. So back to our second tax year. The first 9 months of this first 12 months of trading is that opening short accounting period. But that is only 9 months. We want the first 12 months. So we clearly need another 3 months to bring this up to 12-month period. And that 3 months will be taken from the second accounting period, and the second accounting period will always be a year end, so that's 12 months. 3/12 of what was the profit of this period? It was £60,000. Was it 60,000? Yeah, it was £60,000. And 3/12 of 60,000, well, you've had a chance to work that out now for yourself. 3/12 of 60, that's a quarter of 60, so I think that is some £15,000. Add the two numbers together, 36 and 15 is, I think, £51,000. So there is your assessment for this, the second tax year, the 2021 tax year. As soon as you've got your second tax year, where you had opening period of less than 12 months ended in that second tax year, the third year will be straightforward, and we already know the answer to this. The third tax year is 21-22 tax year. And can you remember what we did when we firstly saw the information in the question? We saw that our first year end was there. The year ended 30th September 21. Only when you have a year end can you use CYB. When would it be usable? From 21-22. So we're now in that 21-22 tax year. Yes, we would use CYB, and that will be the accounting year ended 30th of September 21, in which we made a £60,000 profit. You now have your assessment for 21-22, you're using CYB, you will then continue with your CYB assessments from there onwards until such time as the business ceases to trade. Now, what I'd like you to do just for a moment, because we haven't quite finished with this example and therefore this lecture just at the moment, is to have a little look through, again, the bases of assessment, look at how it is applied and why those rules are applied in this example, rework it through and make sure that you are happy with how this fits with the rules that you then need to learn. Okay, so just pause at this point while you do that. And as you look through again this, something might occur to you about what profits we have used in each of these tax years. And that might give you some concern. Don't worry if the question doesn't arise in your heads. I'll tell you what that question is and answer that question in a few moments' time, once you've had an opportunity to think about this and make sure you are happy, well, as happy as you can be, with what those bases of assessment mean and how to apply them. Okay, well, hopefully you are happy with the way in which we have applied the rules. You might not like the rules, but that's not our call. They are the rules. We simply have to apply them. You don't ever ask in tax here, why? It's not a why, it's an is. The authorities, the powers that be decided, those are the bases of assessment that we will use. We simply have to apply them. Now, going through that, you might have thought, hang on a minute, there's something that doesn't seem quite right here. And that is that we see figures of profit for an accounting period falling into more than one tax year in which those profits are then used to determine the assessment for that tax year. Like here, in the 1920 tax year, we used the 36,000. To be precise, we used the first 3 months of that particular accounting period. But then in 2021, the 36,000 has come up again, and we've used the entire period to September 20. So that means that what we had in the first year, that 3 months, that first 3 months of the period, that £12,000 as we have there, has not only represented the assessment for the first year, it's also become a part of the assessment for the second tax year. We have what we will come to know as an overlap there in terms of a particular figure of profit, here 36,000, a part of that period, the first 3 months of it, has fallen in not just to one tax year, the first tax year, but into 2 tax years. It's the basis of assessment for the first year, and it's a part of the assessment for the second year. And then it happens again. In that second year, we used 3 months' worth of the £60,000, a figure of £15,000 there. And then in 21-22, we've used the whole year end, the full 60,000. So here, 3 months worth of that 60,000 again has overlapped. It is in both the second and in the third tax years. And a requirement that you may have to deal with in a question is to establish in this particular scenario what those overlap profits are. Now, I've identified for you there what profits are indeed the overlap periods. So hopefully you can work that one out for yourself. But where we'll start in our next lecture together is by working out, showing you what that overlap is, the amount of overlap profits, and not just identifying how much overlap profit we have, but then it begs the question, so what? What do we do with it? Because your fear at the moment may be that we have a figure of profit that is being assessed more than once. It's falling into 2 tax years. It's being assessed twice. Ooh, that doesn't sound right. Or dare I use the F word here? It doesn't sound fair. Well, fairness has nothing to do with it. What we'll discover is there's nothing unfair about this, as I'll explain to you in the next session. hopefully before then, you'll have worked what is the overlap profit in these opening years of assessment for this particular taxpayer. Okay, look forward to seeing you in our next session.